Different banking jurisdictions. Understanding the different types of banking jurisdictions. Presentation overview. Banking jurisdictions. Banking jurisdictions define where a bank is registered and govern how it operates in that country. Understanding banking jurisdictions is crucial to understanding the global financial system and how it operates. Onshore and offshore jurisdictions. Onshore and offshore banking jurisdictions have different regulatory and tax frameworks. Understanding the differences between these jurisdictions is important for anyone looking to operate internationally or expand their business globally. Regulatory and tax differences. Banking jurisdictions have different regulatory and tax frameworks. These differences can have a significant impact on how a bank operates and how it is regulated. Global financial ecosystem. Banking jurisdictions work together to create a global financial system. Understanding how these different jurisdictions work together is crucial for anyone looking to operate globally or participate in cross-border financial transactions. Introduction to banking jurisdictions. Legal and regulatory frameworks. Banking jurisdictions are characterized by their unique legal and regulatory frameworks that govern the banking sector. These frameworks can have a significant impact on the way banks operate. Variations between countries. Banking jurisdictions can vary significantly between countries with different legal and regulatory frameworks in place. It is important to understand these differences when operating in the international finance sector. Definition of banking jurisdictions. Legal framework. The legal framework of a banking jurisdiction includes laws and regulations that govern the banking sector. The framework lays the foundation for the banking system to operate within a framework that is transparent and accountable. Regulatory framework. The regulatory framework of a banking jurisdiction includes policies, guidelines, and directives that are issued by regulatory authorities. This framework aims to ensure that banks operate within the legal framework and maintain stability and integrity in the banking sector. Importance of banking jurisdictions. Regulatory compliance. Different banking jurisdictions have different regulatory requirements and compliance standards. International finance professionals must be aware of these differences and ensure they remain in compliance with all relevant regulations. Taxation and reporting. Different banking jurisdictions have different tax laws and reporting requirements. It is important for international finance professionals to understand these requirements and ensure they are in compliance with all relevant laws and regulations. Types of banking jurisdictions. Onshore jurisdiction. Onshore jurisdictions are located within a country's borders and are subject to the laws and regulations of that country. They are typically more stable and secure than offshore jurisdictions, but may also have higher taxes and stricter regulations. Offshore jurisdictions. Offshore jurisdictions are located outside of a country's borders and are subject to the laws and regulations of the country in which they are located. They are typically used for tax planning, asset protection, and privacy, but may also be associated with higher risks and less regulation. Onshore banking jurisdictions. United States. The US is one of the largest onshore banking jurisdictions in the world, with a well-developed financial system that is subject to strict regulations and oversight. It is home to many of the world's largest banks and financial institutions. United Kingdom. The UK is a major onshore banking jurisdiction with a long history of financial innovation and regulation. London is one of the world's leading financial centers with a diverse range of banking and financial institutions. Japan. Japan is a major onshore banking jurisdiction with a highly regulated and sophisticated financial system. Tokyo is one of the world's leading financial centers with a focus on technology-driven financial innovation. Offshore banking jurisdictions. Cayman Islands. The Cayman Islands is a popular offshore banking jurisdiction known for its favorable tax policies and confidentiality laws. Switzerland. Switzerland is a world-renowned offshore banking jurisdiction known for its strict bank secrecy laws and stable financial system. Singapore. Singapore is a leading offshore banking jurisdiction in Asia, known for its favorable tax policies and efficient regulatory system. Differences between banking jurisdictions. Regulatory differences. Onshore and offshore banking jurisdictions have significant regulatory differences that can impact the way banks operate. These differences can include requirements for capital reserves, reporting and compliance, and access to financial markets. Tax differences. Onshore and offshore banking jurisdictions have significant tax differences that can impact the services banks offer. These differences can include tax rates, incentives, and exemptions from specific financial products and services. Regulatory differences. Onshore banking. Onshore banking jurisdictions are subject to the laws and regulations of the country in which they are located. These regulations can be strict and can require banks to follow specific guidelines. Offshore banking. Offshore banking jurisdictions often have looser regulations and may offer more privacy and confidentiality to clients. Tax differences. Offshore banking. Offshore banking jurisdictions are often used for tax planning and asset protection. These jurisdictions may offer lower tax rates and more favorable tax laws than onshore jurisdictions. Increased scrutiny and regulation. Offshore banking can also be subject to increased scrutiny and regulation from tax authorities. This can result in penalties and fines for those who do not comply with the rules and regulations of these jurisdictions. How banking jurisdictions work together. Onshore and offshore banking jurisdictions. Onshore and offshore banking jurisdictions may have different rules and regulations, but they work together to create a global financial ecosystem that facilitates international trade and finance. Global financial ecosystem. The global financial ecosystem is complex and interconnected with banks and financial institutions from different countries working together to facilitate international trade and finance. Global financial ecosystem. Importance of global financial ecosystem. The global financial ecosystem is the backbone of international trade and finance. It connects banks, financial institutions, and markets from different countries and facilitates transactions moving money around the world. Banks and financial institutions. Banks and financial institutions are the cornerstone of the global financial ecosystem. They provide financial services such as loans, investments, and payments to individuals, businesses, and governments. International markets. International markets such as the stock market, bond markets, and currency markets are key components of the global financial ecosystem. They provide a platform for investors to buy and sell financial assets from different countries. Role of banking jurisdictions. Legal and regulatory frameworks. Banking jurisdictions provide the legal and regulatory frameworks that enable banks to operate and facilitate transactions across the globe, ensuring transparency and accountability in financial transactions. Global financial ecosystem. Banking jurisdictions are a crucial part of the global financial ecosystem as they enable banks to operate and facilitate transactions across borders, leading to a more interconnected and efficient financial system. Conclusion. Banking jurisdictions are an important part of the global financial ecosystem. It is crucial to understand the differences between onshore and offshore jurisdictions and how they work together for anyone involved in international finance. Thank you.